The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending 21 February 2020. Well, like everybody else in the alternative media, I guess we'll have to talk about coronavirus, at least at the beginning. From Monday this week, World Trade Organization, this is from Reuters, gives somber goods trade outlook, sees virus threat. No big news here. Growth of global trade has declined. Their numbers go from 95.5 from the previous 96.6 on the November readings. What's interesting to me is on this article it says that there doesn't seem to be much to worry about, that they just see this going. The data indicated recovery would not be sustained, with the decline now looking likely in the January to March period of 2020. And I question that. How do they know how virulent this virus is and what the physical economy is going to look like a month or two from now? And I don't think anyone does. I'm trying to keep a very objective look on this virus situation. I don't know how much is real, how much is fake, how much is propaganda, and what the real physical situation is. I will comment that just about everyone seems to be in agreement that, one, it's real, two, it's damaging, and three, the physical economy is going to suffer repercussions. We just don't know to what level and for how long. The one cautionary statement I'll make, maybe I'll make another one, but the number one in my mind is that pharmaceuticals. It seems that there's like 90 to 95% of the pharmaceuticals actually come from China or have an ingredient from China that's required for the pharmaceuticals at large. So this is something that's quite concerning. If true, I believe it to be, from what I've seen, and I've investigated it to a fairly substantial level to where I'm convinced that that statement's generally a fact. So if you are on prescription drugs, you certainly might want to have a chat with your healthcare provider and see what the real story is for your personal situation. And continuing on this theme, of course, this is from CNBC. Coronavirus could impact 5 million companies worldwide, new research shows. A special briefing issued by the Global Business Research from Dun & Bradstreet analyzed the Chinese provinces most impacted by the virus and found they are intricately linked to the global business network. Well, we all know that. I mean, we don't need Dun & Bradstreet to tell us that the world is a global system, interconnected. Banks are all interconnected. The system's all interconnected. Everything's on the just-in-time inventory. And if something goes wrong in the physical economy, it has a cascading effect. Almost 49% of the companies with subsidiaries in impacted regions are headquartered in Hong Kong, while the U.S. accounts for 19%, Japan 12%, Germany 5%. The new coronavirus outbreak and subsequent shutdown of huge swaths of China could impact more than 5 million businesses. Well, I'd say would, according to the new study. As of Monday, and that was Monday of this week, over 70,000 cases of the virus have been found. That's changing daily, as we know, and the reporting is changing and the testing is changing. So, as I said earlier, how much is true, how much is fake, how much is propaganda, and how much is real, I really don't know. I think generally, as I said earlier, it's real and it's having an impact, and a rather significant one. It remains to be determined of how significant going out into the future. And this sums it up pretty much. No matter what the scenario plays out, the global economy are indicated to churn in their business populations and some lackluster employment and revenue growth in the near term, the company said in a report, meaning this report on all these companies that are intertwined into China in one way, shape, or form. And from Wolf Richter, it starts, Apple throws revenue guidance out the window on supply chain woes and sales collapse in China. And I think the subtitle is even more important. This will become an often played tune over the next few months, delineating how dependent corporate America has become on China. Official reaction to coronavirus, locking down megacities, shutting down parts of the transportation system, and closing factories and retail stores for weeks, etc., largely shut down production and crushed retail sales. And this predictably would do two things to corporate America. First, throw its complex and huge supply chains that crisscross into China into disarray. And secondly, cause sales in China of U.S. brands, mostly made in China, to collapse. You can read the whole article. It's definitely worth it. And Mr. Richter, I don't know if you ever listen to my reports, and it's fine if you do not. I did catch that you, I guess, are doing an update version on YouTube now, and I caught one very recently. Didn't know you were in San Francisco and lived on Lombard Street. Very familiar. I was born in San Francisco. Regardless, let me move on. Again, from Reuters, HSBC to slash investment bank 35,000 jobs in a strategy overhaul. From Hong Kong, HSBC Holdings said on Tuesday it would shed $100 billion in assets, shrink its investment bank, and revamp its U.S. and European businesses in a drastic overhaul that will mean 35,000 jobs will be lost over the years. I think what's interesting is, at some point I'm going to be saying, sell to whom? Who's going to buy these quote-unquote assets? I mean, a lot of this stuff is just paper and really isn't that valuable in the physical economy. Yes, in the financial world it has quote-unquote value, but in the physical economy, and this is what this virus, I think, is going to be pointing out to everyone, that it's the physical economy that really counts. It's not a derivative of the physical economy that you could collateralize and securitize and trade and derivative and hypothecate and rehypothecate and on and on and on with all this stuff. Remember, about 40% of the GDP in this country, in the United States, is based on financial transactions. And for the most part, a lot of that doesn't produce any good to the physical economy. Some does, and I don't have time to go that deep into it, but generally speaking, it doesn't. International Business Times, fairly mainstream, 8 retail stores closing their doors in 2020. No big surprise. It definitely is something that I continue to do almost every week, that the economy is contracting, not expanding. It's getting tougher and tougher out there, not better and better. Yes, Trump has helped the U.S. economy in some ways, and some companies have come back on shore, and others will with this virus situation. And it is a dynamic situation. I don't want to paint a picture that it's static. It's certainly dynamic. It's moving quickly. Nonetheless, the overall system is contracting. And this talks about, Express, JCPenney, Macy's, Bed Bath & Beyond, Pier 1, Barney's of New York, and the Gap. So there you go. Those are your 8, all contracting. I try to stay political, but I can't let this one pass from Zero Hedge. Bloomberg frames farmers as primitive idiots, a demeaning diatribe. I mean, you're probably well aware of this. I won't read it to you. It's one place I've been very consistent, and I haven't said it in the public domain that often, but from my perspective, and this is my weekly perspective, there's 2 areas in the structure of society that I think are woefully inaccurate. One is farmers, how important they are and what their pay scale is. And I'm not talking about the big agri-farms, the big corporately led farms. I'm talking about the generational farms of these hardworking people. And education, and I'm not really for state education, but education and farming, I think, are the most underpaid, underappreciated 2 places in society that are really overlooked. And then, of course, we just worship the sports and entertainment fields where, people can throw a ball or hike a ball or kick a ball or hit a ball. And those that can act and sing. And, I won't be a hypocrite. I certainly am kind of a movie buff, actually. But the point I'm making is that, are we paying these 2 classes, the entertainment industry, is that commensurate with what farmers are making? I don't want to go on and on too much, but I just wanted to point out most politicians, and I'm not trying to just bring out just this one. There's so many that are totally, completely, and absolutely out of touch with the real world, and this is an example of another one. Okay, let's move on to the precious metals. As I'm making this video, gold is up over $25, and in the U.S. market, it's about $16.45 the ounce. Silver's up 18 cents, and it's up to about $18.50 U.S. dollars. Gold certainly outperformed silver and has for quite some time now. Once we broke the $13.50 level, gold shot up. Had some resistance at the 1550 level. It's shot through that level. That resistance has now become support. And we're up about $100 higher than that as I'm making this video today. I'm going to comment on silver. This came out of CPM Group this week, and they talk about the silver market in 2020, pointing out that silver prices rose sharply last year, 2019, going from the 1525 level to as high as 1975 on the 4th of September. That was a one-day event, by the way, and it backed off. It says it should be noted that short-term and long-term investors were buying metal through silver ETFs. ETFs holdings did reach record highs at the end of August 2019. Between June and August, investors added 122 million ounces of silver, mostly before prices began rising most sharply. They flipped over and became net sellers for the balance of the year, but those sales amounted to about 30 million ounces, or 24% of what they had added between June and August. While silver ETF investors were large net buyers of the metals during 2019, that demand was being fulfilled by reductions in unreported private investor bar stocks and was coupled with a lack of fresh buying demand for coin and bars. After the September COMEX contract rolled over, silver prices fell, trading between $16.50 and $18.50. Again, this is from CPM. That is the reality silver is facing as it moves through 2020. In 2019, investor demand for physical silver, which typically drives prices higher or lower, was at its lowest level since 2005. Even so, the price started to rise. Marketing chills say the investment demand had been strong, but they were distorting reality to try to sell silver to investors. Let me comment that a couple things here. Number one, the best dynamics for silver were, for my strong, studied opinion, between basically 2000 and 2006. I mean, we had a 100 million ounce deficit going for about 15 years. That flipped in 2006, and above ground inventories have been increasing since 2006 to present day. So we went from 2 billion ounces above ground in investment form to 500 million ounces roughly in 2006 to basically 2 billion ounces now, maybe 2.5. And I agree that the amount of buying of silver has not been as robust. It's the demand at the margin that moves the market, meaning investment demand. It's not industrial demand, although that's significant and certainly kind of keeps silver at a certain level. I mean, you can only mine it if you're going to break even or make some profit, which is where the primary silver miners are right now. There are a couple of exceptions, but generally speaking, if silver's at $30 an ounce, as an example, you'd see far more silver miners out there getting silver, but you can't, because only the most efficient, best run mines with the best grades, relatively speaking, can mine it and break even or make a profit in some cases. So as he says, I don't think you argue. I know a lot of you may not be that hip on Jeff. I think he does pretty decent work. I don't agree with him on everything, believe me on that. But nonetheless, silver has disappointed investors. Many investors previously lured into buying silver by the distorted commentary of marketing groups have fled the silver market out of disenchantment of the failure of these metals to achieve the unrealistic prices promised by marketeers in the past. Other long-term silver investors have been passing away, and their estates have been selling silver. And I saw that myself. In fact, now that I'm in my 60s, going back 20 years, when I was in my 40s, there's always, every generation, right? So the generation above me had 60, 70-year-old, and I got a few calls, and it was pretty obvious from the main dealers that I talked to on a probably monthly or every other month basis that a lot of blue hairs, gray-haired women were coming in with these junk bags and bars or whatever, silver, what do I do with it? My husband owned this for years, and they would, of course, turn it into their local dealer in most cases and get cash for it and basically put more silver available to the marketplace. And, of course, this is taking place again, as he points out. Many investors have given up on the silver and gold, while others have focused on shorter-term trading rather than long-term buying and holding silver. And that I can't really verify. I mean, there's a lot of people that buy silver and hold it See, gold seems to be more of a buy and hold than silver. At least that's what Jeff claims. I can't prove it one way or the other, but I know that the dynamics in the silver market are people that really expect spectacular gains more so than gold. Most gold people are looking to preserve wealth. Most silver investors are looking to make a huge home run. So, lastly, as he says here, in this environment, silver prices have languished. They probably will continue to rise in 2020, but will be restrained by the lack of investment demand for physical silver in the absence of compelling economic, financial markets, or political reasons to stock up on silver and gold. And I think that's true. And I would say, this came out a little while ago. I mean, based on this virus thing and the way gold's moving today and has this week, I think it will spill over into silver. I've said that several times, and I do still look for a good year this year and a very good year a few years out. In other words, over the next 3, maybe 5 at the most. I doubt it's 5. I think you are going to see a huge move into the precious metals. And, some of those dreams may come true for silver investors that are not too greedy, that are more realistic. But certainly I put out some big numbers and not as big as some of my peers, but nonetheless, I think it still is a very important place to have some of your investment. And at this point in time, with the gold-silver ratio being what it is, if you're just getting started, or even if you're looking to add or maybe even trade, I would certainly favor silver over gold, although I wouldn't be in as a silver-only position. But certainly undervalued, certainly balances a portfolio. You really don't need or want to go overboard. It has, as Jeff pointed out here, disappointed for quite some time and may continue to disappoint. I think silver will perform this year as well as gold. Last year it did not. Gold outperformed silver last year. Time will tell. I'll be back with you next week. Remember, there's nothing more powerful than the truth. And if there was ever a time for the truth, it's now. We need the truth about this virus. We need the truth about the banking system. We need some truth from the political class. We need some truth from the manufacturing class. We really need to get real with each other, especially, again, at times like these. I'll be back with you next week. Hello, I'm David Morgan, publisher of the Morgan Report, and as some of you may already know, the Morgan Report is about money, metals, and mining. In fact, we cover all resources from rare earth elements to precious metals. I've been publishing on the internet for about 20 years. My primary passion is to help people build and preserve their wealth. I love to make people millionaires. I've helped thousands of people via our research in the Morgan Report, which has thousands of paid members and 10 times that amount on our free weekly updates. Here's what you'll receive from our free newsletter. To-the-point webinars, weekly analysis of the financial markets, interviews and our conference schedule, special reports such as riches and resources, and various metals price forecasts. Our paid service client base is primarily small to medium-sized business owners, professionals in the industry, or the seasoned investor who understands markets and the value of precious metals. My area of expertise includes equity analysis throughout the resource sector, energy metals, base metals. We cover startups to billion-dollar corporations. We focus on a special sector that makes money regardless of price oscillations, and the importance of precious metals due to the ongoing currency devaluations. Our team of 3 analysts and support staff can help you build and protect your wealth. It's important for you to know what other people have said. We're passionate about what we do. High integrity and trust. Tell the truth and own it. If we're wrong, we admit it. Take a long-term outlook with major assets and bet a little to win a lot with speculative situations. If you choose to become a client, you will gain financial insights very few, even professionals, recognize. You'll understand the importance of honesty in our financial system. You'll understand how the money system influences almost everything in your life. You'll be prepared for the ongoing currency crisis. And finally, I've chosen to make my life's mission greater than the individual, which means My mission statement is to teach and empower people to understand the benefits of an honest monetary and financial system. It's been a great journey so far, and the best gains in this sector lie ahead over the next 3 to 5 years. I'm fortunate to have earned the status of being a leading authority in my field in helping others protect their wealth. You can email me at support@themorganreport.com or call my office at 480-325-0230.